Imagine a world where your phone battery lasts not just a day, but maybe days.
Yeah.
Where electric vehicles could charge in minutes, potentially go for 1,000 miles. What if a Silicon Valley company actually holds the key to smashing through that long-standing battery bottleneck, changing everything we know about power? Or is it destined to stumble, like so many promising technologies, on the harsh reality of, well, mass production? Welcome to the deep dive. We're the place that takes your source material, digs through it, and unearths the most important insights, basically giving you a shortcut to being truly well informed. Today, we're embarking on a deep dive into Enovix Corporation. They trade on the NASDAQ Global Select Market, ticker ENVX. Our analysis is based on some comprehensive research, current as of June 27, 2025, and reflecting market close data from June 26th when ENVX closed at $10.53 per share. Okay, we've got a lot to unpack about Enovix. We've structured this deep dive into two main parts. In part one, we'll tackle their core business, the leadership team, and the critical financials. Then, in part two, we'll shift our focus to market sentiment, who actually owns the company, and the significant risks involved before, tying it all together with a comprehensive conclusion. Before we dive in, just a quick note, this deep dive is powered by Stock Analytics AI. For just €4.99 a month, members get priority deep dives on any ticker they choose. And over the next few months, Stock Analytics AI is covering all of the S&P 500 stocks. Members get exclusive priority access to these really in-depth reports. If you just want a one-off deep dive, maybe on a company you're following, simply drop them a super thanks. Now let's get into it. Let's begin with Chapter 1, Business Analysis. The battery revolution bottleneck. So Enovix operates with a pretty laser focus, designing, developing, and manufacturing advanced lithium-ion batteries. Their mission seems pretty clear to be the go-to technology provider, basically powering the next generation of high-demand electronics by supplying superior battery solutions directly to device manufacturers, OEMs.
Yeah, and what's really compelling about their approach is this dual revenue strategy. They sell directly to high-value markets like consumer electronics, medical devices, defense. But critically, they also form these strategic partnerships, often involving custom battery development, like with a major smartphone OEM, where payments are actually tied to hitting specific development milestones. And looking ahead, their vast intellectual property portfolio, well, it paves the way for future licensing revenue stream, particularly for the electric vehicle market. Here, they're not aiming to build gigantic battery factories themselves, which is, super capital intensive. Instead, they're looking to license their breakthrough tech to the existing EV battery giants.
Interesting. So what's their flagship product that makes all this possible? What's the core tech?
Right, it's their 100% active silicon anode battery. And this isn't just like an incremental improvement. It's a fundamental leap from traditional graphite anodes. They've got a clear product roadmap too, starting with EX1M, moving to the EX2M and EX3M. These promise pretty staggering energy density improvements. We're talking 22% and then over 30% more power in the same physical space.
Wow, okay. That's significant.
Exactly. And safety is paramount, right? Especially in consumer devices. Their breakflow safety technology is designed to significantly increase the battery's tolerance to abuse, which is a big deal. They also tailor cells for specific applications, wearables, smartphones, even industrial and military uses.
Okay, so where do they actually stand in the market right now? Are they a big player or still emerging?
Well, when you look at their market position, Enovix is definitely a technology disruptor. They're at a crucial pre-commercialization stage. They were founded way back in 2006, went public via SPAC in 2021, and 2025 is really the make-or-break year for their push into true high-volume manufacturing, or HVM as they call it. Their Fab 2 facility in Penang, Malaysia, that's the linchpin here, it's engineered to turn out something like 9.5 to 10 million batteries annually from just a single production line.
One line. That's
So now, yeah, per line.
yeah.
And while their technology has been rigorously validated by third-party labs and major OEMs, I mean, they've got crucial engagements with 7 of the top 8 smartphone OEMs. The big question mark, the elephant in the room, remains their ability to consistently produce these things at industrial scale.
Right, the scale-up challenge. And this brings us to their core value proposition, the real aha moment, you could say. Silicon, as you mentioned, has been this battery world paradox. Incredible potential, stores more than twice the lithium of graphite, but riddled with these fatal flaws, right? Swelling, poor efficiency, limited life.
Exactly. Imagine a battery that swells so much it could literally break your device, loses half its power on the first charge, and then dies way too soon. Those were the holy grail headaches Enovix had to crack. Their genius isn't just improving silicon. It's in their revolutionary 3D cell architecture and this patented stainless steel constraint system.
A constraint system, like a physical jacket.
Kind of, yeah. Think of it as a physical straitjacket for the silicon. It physically conquers that swelling problem. This turns silicon's biggest enemy into its controlled advantage, allowing them to deliver, like we said, up to 30% more power in the same space. That's how you get longer-lasting devices or power-demanding features like on-device AI.
Okay, that makes sense. So they're trying to solve a fundamental physics problem that's held batteries back.
Precisely. And if you connect this to the broader market, Enovix is sitting right at the intersection of several really powerful megatrends. The insatiable global demand for more power, especially with the rise of power-hungry AI applications, it creates an urgent, almost desperate need for higher capacity batteries. This positions Enovix as a potential must-have solution, not just a nice-to-have. They're strategically targeting high-growth end markets. Consumer electronics, EVs, defense, all hungry for better battery tech.
But the competitive landscape, though, it sounds absolutely fierce.
Oh, it is. You've got the incumbent giants, right?
Yeah.
Panasonic, LG, Chem, CATL. They have massive production scale. Then there are other next-gen innovators like QuantumScape and Amprius. And even Samsung is reportedly developing its own solid-state batteries for smartphones, maybe by 2027.
So it's not just competition, it sounds like a race.
It's absolutely a race against time. Their technological lead, it's like a ticking clock. It's a depreciating asset. Every day counts. They must scale to mass production and achieve profitability before competitors catch up, or, even worse, leapfrog them entirely with something new.
And that high cash burn rate we'll discuss later.
That's the sound of that ticking clock. Exactly.
What about regulations? Anything specific holding them back or helping them?
Well, from a regulatory standpoint, the battery industry is notoriously stringent. International safety standards are rigorous. Their breakflow technology is a direct response to that safety concern. Beyond safety, there's increasing scrutiny on environmental regulations. And, significantly, geopolitical factors like the ongoing U.S.-China tariff disputes. That just introduces a layer of market uncertainty that impacts everyone in the supply chain.
Okay, so barriers to entry seem exceptionally high here.
Extremely high. We're talking about incredible capital intensity. Each Enovix production line costs an estimated $60 million. $60 million. Yeah. Then there's immense technological complexity and the need for rock-solid intellectual property protection. They seem to have that. But arguably the largest hurdle, the real monster under the bed, is the manufacturing scale-up. This valley of death, where so many promising technologies fail to transition to cost-effective mass production, that is Enovix's single greatest challenge. It's almost like having the blueprint for a spaceship, but still needing to figure out how to build it efficiently and reliably, without crashing on takeoff.
So what are their actual competitive advantages right now, besides the core tech? Brand, cost.
Good question. Public brand recognition. Pretty low currently. But within the industry and among those major OEMs, they're definitely building a strong, validated reputation. Cost advantages? No, not yet. In fact, they operate at a cost disadvantage right now because of their advanced technology and lack of scale. Their whole strategy to move manufacturing to Malaysia and acquire that facility in South Korea, that's a direct attempt to hit their ambitious target of over 50% gross margins eventually.
Okay, so cost is a future goal, not a current advantage.
Right. And while it's not a traditional network effect, they can create significant switching costs for customers. Once their battery is designed into a high-volume product, say a flagship smartphone, it can effectively lock in that OEM for years. It's hard to swap out a fundamental component like that.
Got it. So the real heart of their potential competitive edge is those unique assets.
Exactly. Three things. First, their proprietary 3D cell architecture, the thing that enables the 100% silicon anode. Second, their robust intellectual property portfolio shielding that innovation. And third, their advanced manufacturing process, which they describe as pattern, stack, constrain, repeat. It's inspired by the semiconductor industry, and that's what they believe will allow them to scale cost effectively. The story of Enovix, really, at its core, it's about this strategic pivot under the new CEO, Dr. Raj Talluri, who joined in early 2023. After 15 years primarily in R&D, they're now making this all-in push to commercialize, starting with that demanding smartphone market.
Okay, this ambitious push clearly demands exceptional leadership. So let's talk about Chapter 2, management evaluation, the people behind the power. A company at this critical juncture, as you said, make or break, it lives and dies by its leadership. And Enovix has almost entirely reconstituted its executive team.
Yeah, the central figure, without a doubt, is Dr. Raj Talluri, appointed CEO January 2023. His resume, I mean, it reads almost perfectly tailored for Enovix's specific challenges. He previously led a $7 billion mobile business unit at Micron Technology. He grew Qualcomm's IoT business to over $1 billion. Critically, he also managed product for Qualcomm's Snapdragon processor business. That gives him deep, direct insight into the demands and, frankly, the politics of smartphone makers.
That Snapdragon experience seems key.
Hugely important. His appointment clearly signaled that strategic shift we talked about, refocusing squarely on smartphones, accelerating the Fab 2 build-out, and pushing through the acquisition of the South Korean facility. And the broader executive team. Largely new, average tenures only about 1.9 years. That shows a very deliberate overhaul to bring in people with commercialization and scaling skills, not just R&D folks.
Okay, Dr. Deluri's resume is definitely impressive. But a brand new executive team brought in specifically for this critical commercialization push. I mean, for some listeners, that might sound like a dynamic turnaround. For others, it's maybe a huge question mark about cohesion and execution under pressure. What's the vibe?
Well, that's exactly the point. The appointment of this new team is the company's very public response to its long journey to commercialization. A bet on Enovix today is, in large part, a direct bet on this specific team's ability to execute where the previous setup, well, struggled to cross that finish line.
Makes sense. How are they on transparency, communicating this high-stakes plan?
They've actually been quite proactive on that front. They maintain a high level of communication with investors, quarterly calls, shareholder letters, detailed investor presentations, even Ask Me Anything live streams with the CEO on platforms like YouTube.
Okay, that's good to hear.
And the leadership team seems well regarded internally too. High employee reviews, an A rating on Comparably, which measures workplace culture. CEO Telluri's compensation is high, yes, over $11 million, but it's heavily performance-weighted. Something like 95% is in stock and bonuses, which strongly aligns his financial interests with those of shareholders. He wins if they win.
Right. And what about capital allocation? Where's the money going?
Their strategy there is absolutely single-minded, reinvesting every available dollar to build the business. The overwhelming priority is funding that manufacturing scale-up. That includes significant capital expenditures, CapEx for Fab 2 in Malaysia, and planning for the next generation Gen 2 line. Their M&A approach seems opportunistic. We saw that with the April 2025 acquisition of a Korean battery facility for just $10 million.
Why?
Well, it was a strategic move. It expands their geographical footprint, provides immediate capacity for their defense business contracts, and crucially, it's expected to save them around $35 million in future CapEx compared to building something similar from scratch. It really is a bet the company focus on the smartphone market right now. They fundamentally believe success there will pave the way for expansion into all those other lucrative markets later.
And shareholder returns, dividends, buybacks.
As you'd expect for a pre-profitability, high-growth company like this, they don't return capital to shareholders. Enovix pays no dividend, has no history of share buybacks. They rely entirely on the public markets for funding. That includes their 2021 SPAC merger, which took them public, and a $100 million equity offering back in October 2024. They sell stock to fund operations.
Okay. And return on invested capital, ROIC, you mentioned it earlier.
Yeah, for a company still in this heavy investment phase, it's deeply negative, standing at negative 57.33% for the trailing 12 months. It looks bad on the surface, but it reflects the massive capital being poured in while they're still incurring losses. For you as a listener, the key isn't that current negative figure itself. It's the potential for ROIC to turn powerfully positive if their strategy succeeds and they hit scale and profitability.
Right. It's about the future potential, not the past performance. So the vision is clear, the team is in place, the strategy seems focused. But at the end of the day, with any company, especially one burning cash like this, it comes down to the numbers. Let's crunch some figures and dive into Chapter 3. Financial analysis. The numbers story. Let's kick off with market capitalization. As of June 26, 2025, Enovix had about 192 million shares outstanding. That values the company at roughly $2.02 billion. And it's absolutely crucial, as you said, to understand this valuation isn't based on current performance at all. It's built entirely on significant market expectations for explosive future growth.
Exactly. And when you look at revenue growth, Enovix is, in essence, still a pre-revenue company that's just begun commercialization. They reported zero revenue in 2020 and 2021, then jumped to $6.2 million in 2022, $7.6 million in 2023, and $23.1 million in 2024.
Okay, those jumps look big percentage-wise.
They do, but remember, it's from an extremely low base. The entire investment thesis, the whole story, hinges on revenue accelerating dramatically as their high-volume manufacturing facilities finally come online. Analysts are forecasting nearly $37 million in revenue for 2025, but that's still just a forecast.
Got it. Now, profit margins. You mentioned a key milestone.
Yes, this is critical. Margins have historically been deeply negative. I mean, they were losing money on every battery they made initially, but that changed in late 2023 and early 2024. They hit their first ever positive non-GAAP gross margin in Q1 2024, and now, importantly, they have 2 consecutive quarters of positive GAAP gross margin.
Why is that specific GAAP measure so important?
Because GAAP includes all the costs, like stock-based compensation. Hitting positive GAAP gross margin is perhaps the single most important data point recently. It offers tangible evidence that their unit economics can be positive. It makes management's long-term target of greater than 50% cash gross margins at scale seem, well, at least plausible.
Okay, so gross margin turning positive is a huge step. What about operating and net margins?
Still deeply negative, and likely to remain so for a while due to the massive ongoing investments in R&D and sales, general and admin SG&A. They're still building the plane while flying it.
And free cash flow, the cash burn.
Yeah, that tells the story of significant and, until recently, growing negative cash flow, the cash burn. They used $51.3 million in cash from operations in 2021, $82.7 million in 2022, and $104.6 million in 2023. This continued into Q1 2024, $35.78 million used. In Q1 2025, $16.9 million used. That Q1 2025 number being lower is positive, but it still highlights the incredibly capital-intensive nature of building this business from the ground up.
Okay, and earnings consistency.
Well, there are no earnings to be consistent with. The company has consistently generated significant and growing net losses every single year since its inception. For example, a huge $222.2 million net loss in 2024.
Right, so how stable are they financially given all this? Debt, liquidity.
Let's look at their debt-to-equity ratio. It was 0.756 or 75.6% as of March 2025. Now, they do hold more cash than debt currently, which is good, but still, that level of leverage for a pre-profitability company adds financial risk, and the ratio has been creeping up. It's something to watch. However, their current ratio is very strong at 4.68.
What does that mean practically?
It indicates they have ample short-term liquidity, enough cash and equivalents on hand to cover their short-term obligations for the coming year, roughly. This buffer is absolutely crucial for sustaining that high cash burn while they ramp up.
Makes sense. And valuation metrics, PE, PS?
Traditional metrics are almost useless here. The price-to-earnings PE ratio is meaningless because there are no earnings.
Yeah.
And price-to-sales PS is extremely high, over 67 times trailing sales.
Why so high?
Because, again, the market isn't valuing current sales. It's pricing in massive, massive future growth. It's all about expectations.
So standard metrics don't work. How do you try to value a company like this?
That's where an intrinsic valuation approach, like a discounted cash flow or DCF, analysis becomes more relevant, though still highly speculative. It tries to estimate a company's true worth based on its future cash generation potential. Our educational DCF model, which is built on some pretty critical assumptions, suggests an estimated intrinsic value for Enovix in a pretty wide range, $9 to $16 per share.
What are those critical assumptions?
Things like explosive annual revenue growth. Our model used 46.4% annually for several years, achieving profitability within 3 years, followed by more normal stabilization phase. These are big ifs. And the discount rate, the weighted average cost of capital, WACC, is crucial. Given the high risk here, pre-profitability, huge execution risk, high stock volatility with a beta around 2.0, a conservative discount rate in a 12% to 15% range seems appropriate. Higher risk demands a higher discount rate.
So wrapping up the financials, the numbers paint a picture of a company deep in that capital-intensive valley of death.
Absolutely. Its survival hinges entirely on its ability to use external funding from selling stock and taking on debt to build a self-sustaining business before the money runs out. With a cash balance of $248 million at the end of Q1 2025, they have approximately 2 years of runway at the current burn rate. That puts immense pressure on management to execute this Fab 2 manufacturing ramp-up flawlessly and critically on schedule.
Okay, that sets the stage perfectly. Now, let's shift our focus to part 2 and start with chapter 4. Market sentiment, the Wall Street narrative. How is Wall Street actually viewing this high-wire act? You mentioned analysts. Overall bullish.
Yeah, the analyst community overall is leaning bullish on Enovix, but that optimism is clearly tempered by significant uncertainty, and you see that starkly reflected in the wide dispersion of their price targets.
What do the ratings look like?
The consensus rating tends to be a moderate buy, or sometimes a strong buy, across various platforms, based mostly on buy ratings. However, the price targets themselves are just exceptionally wide. We're talking from a low of maybe $7 all the way up to $100 per share. The average tends to hover around $17 to $26.
Wow, $7 to $100. That's a huge range.
It's a classic sign of a high-risk, high-reward stock where there's very little agreement on the ultimate outcome. It signals deep uncertainty. It's also noteworthy that several analysts, including big names like JP Morgan and Benchmark, have recently lowered their price targets, even while keeping their buy ratings.
Why lower the target if they still recommend buying?
They often cite things like broader market compression for growth stocks or wanting to de-risk their models given the execution uncertainties, basically acknowledging the increased risk or longer timeline.
And you mentioned the stock is sensitive to news.
It's extremely sensitive. Positive announcements, manufacturing progress, new partnerships, acquisitions consistently cause the stock price to surge. We saw that huge 20.76% jump just on June 26, 2025, which was attributed partly to heavy call option buying and trading volume, anticipating good news perhaps. Conversely, any news raising concerns about cash burn, profitability, or crucially manufacturing delays, that can lead to really sharp declines. The media narrative generally frames Enovix exactly as you'd expect. A quintessential high-potential, high-risk technology disruptor,
Right.
a potential rocket ship, or a dud.
What about other market indicators? Anything interesting there?
Oh yeah, what's truly fascinating here is the short interest. It's exceptionally high. Reported recently at 27.15% of its publicly available shares. The float.
27%. That's massive. What does that signal?
It's a major red flag, frankly.
Huh.
It signals that a significant portion of the market is actively betting against the company.
Yeah.
They're shorting the stock, expecting the price to fall. It makes Enovix a classic battleground stock.
Yeah.
This high short interest also translates into a high days to cover ratio, recently reported between 12.5 to 15.4 days.
Meaning?
Meaning it would take over 12 days of average trading volume for all the short sellers to buy back shares to cover their positions. This dynamic can set the stage for a potential short squeeze.
The short squeeze. Explain that quickly.
If good news hits unexpectedly, the stock price jumps. Short sellers start losing money rapidly and are forced to buy back shares to limit their losses. This buying pressure from the shorts can itself drive the price even higher, even faster, creating a rapid upward spiral.
Got it. Any technical signals from the stock chart itself?
Yeah, looking at the technicals as of June 26, 2025, Enovix's closing price of $10.53 was significantly above its 50-day simple moving average, which was down around $7.56. That typically indicates a bullish short to medium-term uptrend. What's maybe more significant is that the price also recently moved above its 200-day moving average, which was hovering in the $8.87 to $9.18.
And why is the 200-day average important?
A sustained move above that long-term trend line is often interpreted by technical analysts as a significant bullish signal. It potentially suggests a shift in the long-term trend from bearish or neutral towards a more bullish outlook. Of course, technicals are just one piece of the puzzle.
Right, so putting it all together.
So the market for Enovix stock isn't just a market. It really is a powder keg of conflicting views. You have these entrenched bulls who see immense long-term potential. You have an enormous short interest from bears betting heavily on failure. And you have high volumes of speculative call option buying from traders, maybe playing for that short squeeze or just betting on volatility. This creates this intense tug-of-war that leads to dramatic price swings. The stock's price right now is almost as much a function of this intense market battle as it is of the company's fundamental progress or lack thereof.
Fascinating dynamics. Now let's turn our attention to Chapter 5, ownership structure. Who's at the table? Who actually owns this volatile stock? You mentioned institutions earlier. How much do they own?
Yeah, institutional investors own a pretty significant chunk of Enovix, roughly 49% to 51% of the outstanding shares. That clearly indicates it's on the radar of professional money managers. They're involved.
Any big names? Or specific types of institutions?
Well, the top institutional holders include the usual passive index fund giants, the Vanguard Group, BlackRock, Inc. Their large positions are mostly because Enovix is included in various broad market indices, like the Russell 2000. They have to own it. But beyond those passive giants, you also see more active, growth-oriented firms holding positions. Names like Electron Capital Partners, Fred Alger Management. These signal specific active bets on the company's future success. Institutional activity, buying and selling, had been pretty mixed recently. Some active managers seem to be increasing their stakes, while others have trimmed their positions, perhaps taking some risk off the table.
What about insiders, management and the board? How much skin do they have in the game?
That's a key indicator, right?
Yeah.
Management's confidence. Insiders at Enovix maintain a significant holding, reported somewhere between 13% and 16%.
That sounds pretty high.
It is. It's a strong positive signal. It aligns their financial interests directly with common shareholders. The company's chairman, Thurman Rogers, who is a founder, I believe, is the largest individual insider shareholder, owning about 12% himself.
Have insiders been buying or selling recently?
Looking at recent transactions, there have actually been more shares sold than bought by insiders. However, it's important to dig into why. Many of these dispositions seem to be non-open market transactions, things related to stock award vesting and automatically selling shares to cover tax liabilities, not necessarily insiders thinking the stock is peaking and cashing out based on a negative outlook.
Okay, that context is important. So high insider ownership, significant institutional holdings, is ownership concentrated?
Actually, despite that significant insider stake held mainly by the chairman, overall ownership is quite widely disseminated. The top 25 shareholders collectively own less than half the company. This means no single dominant shareholder truly controls the strategic direction. And a very large portion, estimated around 40%, is held by the general public or retail investors.
40% retail. Wow, what does that imply?
Well, this large retail float definitely contributes to the stock's high volatility and its battleground status we discussed. Retail investors can sometimes be more sentiment-driven. It also means that for long-term success, management must not only flawlessly execute its business plan, but also successfully manage the public narrative to maintain the confidence of this crucial, diverse, and very large retail investor base. Communication is key.
Okay, very clear picture of the ownership. Moving on, we absolutely need to honestly assess the challenges and potential pitfalls. Let's dive into Chapter 6, Risk Assessment. Hurdles on the road to scale. This is where we break down the classic SWOT analysis. Strengths, weaknesses, opportunities, and threats for Enovix. Let's start with strengths.
Okay, strengths. At the core, it's their proprietary technology. That unique 100% silicon anode 3D cell architecture we talked about. It offers a clear, proven energy density advantage. And it's protected by a strong intellectual property portfolio, their patents. They also have, as we discussed, an experienced, incredible management team now, led by Dr. Talluri, whose background seems directly relevant to their commercialization push.
Yeah.
And finally, those strategic customer partnerships and engagements with top smartphone OEMs and defense sectors, they powerfully validate that there is market interest in their solution. Big players are paying attention.
Okay, those strengths are undeniable, but they seem to directly butt up against their single greatest weakness, right?
Without question. Their single greatest weakness, and frankly their biggest risk, is manufacturing scale-up and commercialization. They simply haven't proven yet that they can mass-produce these complex batteries consistently with high yields and at competitive costs. This isn't just a hurdle, it's that valley of death that has swallowed so many promising hardware and material science technologies.
And that leads to...
That leads directly to their other major weaknesses: high cash burn and continued unprofitability. They are dependent on external capital markets to survive right now. Their initial production costs are still high, and their current, albeit small revenue stream shows significant customer concentration. In 2023, a single military subcontractor accounted for most of their sales. That's risky.
Okay, weaknesses are clear. What about opportunities? Where's the potential upside?
Opportunities are vast. They're positioned in potentially massive addressable markets. Smartphones, yes, but also electric vehicles, augmented and virtual reality, medical tech. All these sectors are craving more power and longer battery life. That insatiable AI-driven demand for higher energy density we keep mentioning, that's a powerful tailwind, practically creating a must-have scenario for technologies like theirs if they can deliver. And interestingly, geopolitical trends towards supply chain diversification away from China could significantly benefit Enovix, given their strategic manufacturing facilities in Malaysia and now South Korea.
Right, positioning outside China could be a plus. But the threats are real too. What looms large?
The threats are definitely real. First, the battery industry is hyper-competitive. There's the constant risk of being out-innovated by incumbents like Panasonic or CATL, improving their existing tech faster than expected. Or perhaps more existentially, being leapfrogged by entirely new solutions, like those solid-state batteries we mentioned earlier, if they mature faster than anticipated.
Technological obsolescence is a big one.
Huge. Then there are macroeconomic factors. An economic downturn would undoubtedly dampen consumer spending on new gadgets and slow EV adoption, hitting their target markets hard, and broader headwinds like persistent inflation or higher interest rates. Those increase their operating costs and financing costs, and generally put downward pressure on the valuation of high-growth, pre-profitability stocks like Enovix.
You mentioned geopolitical factors like US-China tariffs earlier. Can we dive a bit deeper into that? How might hypothetical new tariffs in, say, 2025 impact Enovix specifically?
All right, that's an important question. Since Enovix manufactures in Malaysia and South Korea, they would not be directly subject to the most severe hypothetical tariffs targeting Chinese-made goods. On the surface, that could look like a competitive advantage compared to rivals manufacturing batteries in China,
Ooh.
but the indirect effects could still be quite detrimental. Such broad tariffs could destabilize the entire U.S. energy storage and electronic supply chains. It could increase overall system costs for the OEMs, their potential customers, by maybe 15–25%, potentially delaying new product development cycles as they reassess costs. Enovix could also face rising costs themselves if some of their raw materials originate from China, even if assembly is elsewhere. And there's always the risk China might retaliate by restricting exports of critical raw materials needed for batteries.
So it's complicated.
Very. While their manufacturing locations provide some insulation from direct tariffs, they are certainly not immune from the broader chaos and uncertainty of a trade war. OEMs might just become more risk-averse in general and delay adopting new, potentially premium-priced components, like Enovix's batteries, sticking with what they know, even if it's inferior tech.
Okay, a thorough risk assessment. We've covered a lot of ground. Now let's bring it all together. We've reached the final stretch. Chapter 7. Conclusion. The verdict on Enovix. Let's synthesize everything we've covered, starting with the key bullish points. The compelling bull case for investing in Enovix. Why would someone bet on this company?
Okay, the bull case. It really is a compelling narrative of technological disruption, isn't it? Enovix has a validated, proprietary battery architecture that offers a significant tangible lead in energy density that directly addresses the critical battery bottleneck created by power-hungry applications like AI. This potential solution opens up an enormous market opportunity across multiple large industries, positioning them to capitalize on powerful long-term growth trends. Their management team, now led by Dr. Talluri, is credible and laser-focused, with deep, directly relevant experience in scaling advanced technologies and navigating the smartphone world. There's also now a tangible path to profitability, supported by that clear manufacturing roadmap and, crucially, the recent achievement of positive GAAP gross margin. That makes their aggressive long-term target of over 50% gross margin seem genuinely attainable, not just aspirational. And finally, that strong customer validation through deep engagements with major electronics companies. It speaks volumes about the market's interest and belief in their technology's potential.
Okay, that's a strong bull case. But every story has two sides. Let's lay out the bear case. Why might someone bet against Enovix or be very cautious? What are the core arguments grounded in the immense difficulty and risks ahead?
Right, the bear case. The single most important risk, and it overshadows everything else, is extreme execution risk. Plain and simple. They have yet to prove they can successfully transition their complex technology to reliable, high-yield, cost-competitive, high-volume manufacturing. That is the ballgame. This leads directly to the second major risk, high cash burn and ongoing financial risk. They are unprofitable and utterly dependent on external capital markets. Any significant delays in manufacturing or revenue ramp-up could force further, potentially highly dilutive capital raises at unfavorable terms.
Dilutive meaning issuing more stock, lowering existing shareholders' ownership percentage.
Exactly. Then there's intense competition and the risk of obsolescence. Incumbents could improve their existing tech faster, narrowing Enovix's advantage. Or entirely new technologies, like solid-state batteries, could mature and leapfrog them before Enovix even gets fully established. Their current multi-billion-dollar valuation is undeniably lofty, based almost entirely on future potential, not current reality. This makes the stock highly vulnerable to shifts in market sentiment or any execution stumbles. And finally, those external threats we discussed, economic downturns, raw material volatility, geopolitical tensions, they all loom large and add significant layers of uncertainty beyond the company's direct control.
So how does our valuation attempt fit into that DCF range?
Yeah, our educational discounted cash flow analysis, which trying to quantify that future potential while accounting for the significant risk via the discount rate, suggested that estimated intrinsic value range of $9 to $16 per share. But it's absolutely crucial for listeners to remember this is a hypothetical estimate. It is highly dependent on the company successfully executing its incredibly ambitious growth plans and actually achieving sustained profitability. It's a model, not a crystal ball.
Okay, so what does this all mean for you, our listener, trying to make sense of Enovix? As of June 26, 2025, that share price of $10.53 falls squarely within our estimated intrinsic value range. What this suggests is that the market, at least on that day, might be fairly pricing in this profound dichotomy of the Enovix story. Immense, potentially world-changing technological potential on one hand, and significant, potentially company-breaking execution risks on the other. An investment in Enovix at this level, therefore, isn't a traditional value play based on current earning for assets. It's clearly a high-risk, potentially high-reward venture. It's essentially a direct bet on the ability of the specific management team to navigate that perilous valley of death of manufacturing scale-up and deliver on its ambitious promises before its technological window of opportunity closes or the money runs out.
Which leaves us, and you, with a really provocative final thought to consider. If you were a top executive at a major smartphone OEM, or maybe an EV maker, deciding on the battery for your next generation of flagship devices, how would you weigh the groundbreaking energy density advantage offered by Enovix's batteries against their still unproven high-volume manufacturing capabilities, their higher initial cost, and the inherently volatile market and financial dynamics surrounding the company? That's the multi-billion-dollar decision OEMs are grappling with right now.
And that concludes our deep dive into Enovix. We really hope this has given you a clearer, more informed perspective on this fascinating, complex, and high-stakes company. Don't forget to like this video and subscribe to Stock Analytics AI on YouTube. Remember, members get priority deep dives on tickers they request. And Stock Analytics AI is covering all of the S&P 500 stocks over the next few months. Members get exclusive priority access to those reports. Or if you just want a one-off deep dive on a specific company that interests you, just drop them a super thanks on the video. And a final, very important reminder, this deep dive was generated by an AI system using financial data and analysis for educational purposes only. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us on the deep dive. We'll be back soon with another stack of sources to unpack for you.